Millions of homeowners are sitting on hundreds of thousands of dollars in idle equity. And the best part, they don't even realize it. It's not just paper wealth, it's usable capital. Used strategically, it can change your financial trajectory. Today, we're talking about how home equity via home equity lines of credit and home equity loans can be used to reduce high interest debt, fund new business ventures, improve your home, or even build a real estate portfolio. Let's talk about what's available, what's smart, and what's risky. I'm Darren Hunter. I help homeowners in North Metro Atlanta and beyond, actually in 27 states, turn financial complexity into clear strategic action. And this is one of the most misunderstood tools on the table. Home equity is not just a number on your statement. It's capital you can actually deploy, but only if you understand the structure, the strategy, and the stakes involved. This isn't a pitch. I'm not here to sell you. It's a guide to using home equity intelligently. So let's talk about the basics. Home equity is the value of your home minus what you still owe on your mortgage. If your home is worth $500,000, your remaining loan balance is $275,000, you have a total of $225,000 in equity. And here's another great part. You're not alone. Americans collectively hold around $35 trillion in home equity. Nearly half of all mortgage holders are considered equity rich, meaning they owe less than 50% of their home's value. This equity can be accessed through a home equity loan or a home equity line of credit, commonly known as a HELOC or HE loan. So let's break down the two differences. A home equity loan is a lump sum loan with a fixed interest rate and a fixed repayment schedule, anywhere from a 5-year term all the way to a 30-year term. You know exactly how much you're borrowing and your payments will never change. A HELOC, by contrast, works a little bit more like a credit card. You get a credit limit and you can draw funds as needed during the draw period. Usually there's anywhere from 3 to 10 years. During this time, typically you pay only interest on the amount you have borrowed. After that, it converts to a repayment phase, often another 10, 20, or even 25 or 30 years. HELOCs typically have variable interest rates, but nowadays, a lot of lenders will let you lock in a fixed rate on part or all of the balance that you obtain. That can offer both flexibility and predictability. Here's why this matters. Interest rates on credit cards are currently averaging over 20%. HELOCs and home equity loans, first of all, they start at prime, which as of today is 7.5%. So typically you're going to see them in the single digits. So if you're carrying high interest debt, this can be a significant cost reduction, and borrowing capacity is substantial. Lenders often allow you to borrow up to 90% of the home's value, depending upon your credit. It is certainly credit heavy. If your house is worth $600,000 and you owe $300,000, you may be eligible to borrow around $210,000, and that's at 85%. That's real, actionable capital. So let's talk about how you can use it wisely. One of the most financially sound uses of home equity is to consolidate expensive, unsecured debt. If you're paying 20% or more interest on multiple credit cards, replacing that with a home equity loan or home equity line at around 8% and fixed monthly payments could improve your cash flow and reduce long-term interest costs significantly. Let's say, for example, you're making $800 a month in combined minimum payments on $30,000 of credit card debt. A $30,000 HE loan at 8% over 10 years may drop that monthly obligation to around $365. You save money, you simplify payments, you create room in your budget, but discipline is key. Don't treat this paid off credit card as available credit. This strategy works only if you avoid creating new debt and not adding to the problem. If you're a business owner or looking to start something new, access to capital can be a difference between the growth and stagnation. Home equity often provides a more affordable, accessible option than traditional business loans, especially if you're a startup. Instead of paying 10 or 15% on an unsecured loan, a home equity loan might get you the same funds between 7 and 9% depending upon your credit. And with a home equity line of credit or HELOC, you can draw in phases as expenses arise. Ideal for rolling launches, inventory cycles, or marketing efforts. Just remember, the money is still tied to your house. Borrow only with a strong business plan and a clear repayment structure. Putting equity back into your property itself is often the safest play. Upgrades like kitchen remodel, new roof, or an additional bathroom not only improve your living experience, they may increase your resale value. So let's say, for example, you borrow $50,000 to update your kitchen and your master bath. If those upgrades increase your home's market value by $70,000, you've effectively grown your net worth by $20,000. Also, if the funds are used to buy, build, or substantially improve the home, the interest on that loan may be tax deductible. This strategy is both practical and wealth building, especially when managed within your means. Tuition bills are growing faster than most incomes. Home equity can help bridge the gap without high interest student loans, especially if you're looking at private loans or Parent Plus loans with interest rates above 7%. With a HELOC, you can draw funds semester by semester, only paying interest on what you use. But proceed with caution. Federal student loans come with protections that home equity loans do not, like income-based repayment plans and potential forgiveness programs. Home equity might be a better fit for graduate school, professional training, or covering a funding gap after all the aid options have been explored. This is how real estate portfolios get built. Use equity from your primary residence to purchase a second property or rental unit. This avoids cashing out retirement accounts or liquidating any other investments you might have. And unlike a full refinance, it preserves your original mortgage rate. You're adding an asset without sacrificing your favorable primary loan terms. If you refinanced in the last several years, I'm certain you're sitting at a 4% or below. And rental income may cover the new debt entirely. But, there's always a but, be aware, you're also adding leverage. That means more responsibility and more risk. Make sure your numbers work before committing. Unexpected events don't wait for your savings account to be ready. Home equity can function as a safety net, but only if the line of credit is already open. If you lose your job or face a sudden medical bill, a HELOC gives you access to those funds without scrambling. That said, it's not a substitute for savings, and it should never become your go-to for daily expenses. This is emergency liquidity and nothing more. Every strategy has a trade-off, and with home equity borrowing, the main risk is obvious. Your house is your collateral. If you fail to repay, the lender can foreclose. So only borrow what fits within your monthly budget for now and if rates increase. And always keep a buffer. Lenders may allow you to borrow up to 90% of your home's value. That doesn't mean you should. Consider keeping at least 20% equity untouched to ride out any market volatility. Variable rates on home equity lines of credit mean payments can increase unexpectedly. Look for lenders offering fixed rate conversion features. Before tapping into equity, ask, what's the exact purpose for this loan? What's my total monthly payment, including my current mortgage? How will I repay it if my income drops? Will this decision improve or weaken my financial health in 5 years? This isn't free money. It's borrowed money at a better rate tied to your home. Use it to build stability and long-term value, not for short-term lifestyle boosts. Your home isn't just where you live. It's a financial asset with a strategic utility. Used wisely, your home equity can reduce your monthly expenses, fund income-producing projects, improve your home's value, and help you weather emergencies. But the key word is wisely. Have a plan, run the numbers, know your limits, and work with someone who treats your equity with the same care you treat your home. If you've got questions or need help evaluating your options, I'm here. Let's get clear on what's possible and what's prudent, and that, my friends, is guaranteed.